Thank you for joining today's webcast. Your moderator for today is Mr. Joost Vreeswijk. Sir, you may begin.
Thank you. Hello everybody. Welcome to this EY Thought Center webcast on BEPS is broader than tax, the impact on operating model and the deployment of intellectual property. This is the second in a series of 7 webcasts where we step away from the core tax topics and focus on the implications of BEPS for business leaders. My name is Joost Vreeswijk and I'll be your moderator today. We have 5 more webcasts coming up in the topics of BEPS is broader than tax. The link below allows you to register for each of these. You can also actually replay these webcasts whenever you like, and we encourage you to do that, of course. Now for today we have 2 objectives. First, we want to give you a quick overview of what BEPS actually is, how it came about, what the key focus areas are. And what we really want to do is give you as business leaders a baseline on BEPS and to make sure that you actually can see that it's impacting a number of business areas and that you're aware of that. Now secondly, what we want to do is make sure that you, through a number of business scenarios and examples, get more of a feeling for what this really means. And again, this is all with an objective for you to have more meaningful conversations with your tax colleagues as and when you're addressing business change. Now with me today to go through all of this, I've invited a number of outstanding EY professionals with very diverse and significant backgrounds and experience in this. Let me introduce them. So first of all is Barbara Angus from the US. Barbara is the EY Global Strategic International Tax Policy Leader, and that's a mouthful, but she's actually instrumental in a number of our BEPS responses and overall the BEPS project. Previously, Barbara held the top international tax position at the United States Treasury Department, and she was a vice chair on the OECD Committee on Fiscal Affairs. So I'm very happy Barbara's with us today, and she's been really instrumental in EY's kind of response to BEPS. And today on the call, she is the tax person and the tax voice of reason on today's call. So great to have you, Barbara. Next is Jürgen Lange from the Düsseldorf office in Germany. Jürgen is a business advisory partner specializing in large-scale business transformations, and he's worked close with a number of tax colleagues. So again, very interesting, relevant experience. From London, we have Julian Tasker, a director and a member of our dedicated operating model effectiveness team. Julian has a background in logistics, distribution, supply chain, in both industry and business advisory, and he also spent considerable time in Asia. So again, he'll bring us those perspectives. Then from Zurich, we have Wes Paulus. And Wes focuses on supply chain and procurement. She leads our practice in Switzerland, and she will contribute specifically on the procurement side of things today. And finally, Andrew Watson, joining us from the UK, and he's heading up that firm's IP strategy practice. And Andrew is specializing in intangibles and intellectual property. And again, that's a very key point of BEPS, as you'll hear later on in the webcast. Now, before we start, 3 administrative points to deal with. First, and we will take questions throughout the session, so you can put your questions and comments in the Q&A or via the Q&A icon at the bottom of your screen of your interface. What we'll try to do is answer some of those questions if they are not already covered in some of our conversation, and if not, then we'll follow up with them individually to make sure you actually get a question on your an answer on your question. Secondly, there will be so-called silent polling questions. And they appear throughout the webcast. And if you are, if you want to qualify for CPE or CE credits, educational credits, then you need to respond to these silent polling questions. And they appear every 15 minutes or so. Now, last housekeeping point before we get started: you can download the material that you see on the screen, and you can click on the green folder icon at the bottom of the interface to do that, so you can study the materials later. Right, having said that, let's get started. And before I ask Barbara for the depth of what BEPS actually means, I just want to stress one thing up front, and that's really the core of the matter here. We truly believe that BEPS has the potential to impact your entire operating model and all aspects of your operating model. So when you're assessing that, you should think about things like your people, where they are based, how they are organized, and which locations they work, the business processes that you run, and specifically how the business makes decisions and where they get made, the governance mechanisms that you use to run these operational activities, but also your supply chain footprint, your networks, your inventories, and we'll see that later too, and then your systems and transactional models, your transfer pricing, and your legal entity organization. Now, last but not least, which of your assets, tangible or intangible, are really driving value in your business, and which one are the key ones. So what you'll find out is BEPS actually touches on a number of areas in the operating model. Now, so that's just setting the scene, and we'll get into all these examples later on to make that a little bit more clear for you. Barbara, with this in mind, can you please explain the context of BEPS, base erosion and profit shifting? What does it actually mean, and why did the OECD start this project, and what are we trying to achieve with that?
Sure, Joost, thank you. So the BEPS project, and as you say, BEPS stands for base erosion and profit shifting. It's an initiative of the G20 and the OECD. Because of government concern about the potential for multinationals to artificially locate profits where they're subject to favorable tax treatment, the G20 requested that the OECD develop recommendations for changes in international tax laws and treaties that governments can implement in order to reduce the potential for base erosion and profit shifting activity. The OECD, in answer to this request, over a couple of years, developed a 15-point action plan and issued final reports on those actions in October of last year. The focus areas fall broadly under three work streams: coherence. Tax laws of countries should be internationally coherent and not leave any income inappropriately untaxed or double taxed, for that matter. The next of the prongs identified by the OECD is transparency. Tax authorities should obtain insight into the global operation of taxpayers and also should share relevant tax information with each other. And finally, substance. Profit should be taxed where value is created. This is a relatively subjective area, and the OECD, as we'll talk about in more detail, has really chosen to focus in particular on people functions for purposes of determining the profit allocation of profits. But as we'll talk about, there's some tension there. Based on the OECD recommendations in the final reports, and really in many cases earlier than those final reports, many countries have started to make BEPS-driven changes to their tax laws and administrative practices. So broadly, the OECD's recommendations include changes that would limit interest deductions. That's relevant, for instance, for CapEx spending, acquisitions, working capital location. Increased limits would increase the weighted cost of capital and could have an impact on business investment proposals and valuations. Recommendations would lower the thresholds for creating a taxable presence in a country with inventory holding and warehousing functions, and also sales activities being particular targets. The recommendations would adjust the transfer pricing rules, as I said, to focus more on people functions and correspondingly somewhat less on risk and capital. Also, the definition of intangibles and intellectual property has been expanded, and probably even more significantly, the rules for determining who's entitled to the income from intangibles are being revised as part of these recommendations. And then also in the transfer pricing area, the recommendations require much more detailed transfer pricing documentations. So enterprises will now need to submit information on their entire global footprint: profits, people, revenues, taxes, equity, assets, to the tax authorities, representing really quite substantial and new types of information about their global operations. There certainly are quite a few other complex recommended changes, but maybe we should get going with these for now. And before we do that, I do want to emphasize that this is not limited to the OECD countries. Both OECD and G20 countries have participated in the BEPS project, as well as other developing countries. So among the OECD countries that have been involved in all aspects of the project are Brazil, China, and India. and also participants from about a dozen developing countries. So there's broad buy-in from countries around the world. Moreover, further increasing the countries that are involved, sort of further expanding the reach of the BEPS consideration as it moves into the implementation stage, is a definite priority for the G20 in 2016.
Yeah, thank you, Barbara. And I think it's very important, that last point. There's a serious amount of actually drive behind this to make these things all a true reality in the various countries. Now, we are focusing today's conversation mainly on the impact of BEPS on operating models. So, Barbara, I understand from what you just said that managerial and decision-making substance is a real cornerstone. That's one of those three big blocks you mentioned earlier. And obviously, tax laws and laws are country-specific, but if you look at multinationals, they actually operate, many of them anyway, on a global basis. So if I look at this, a clear example is supply chain management. If you look at that, I think we're past the days where a country manager had its own sourcing, its own factory, warehouse, its own inventory, and transfer to its own local customers. Instead, what you see today, supply chains are truly international, stretching into low-cost manufacturing countries, global sourcing of materials, major trade routes, big logistics networks, inventories deployed in many places to support really demanding service levels from customers. So now all of that is obviously supported by a new set of business processes, systems, and managerial constructs that really run above the markets rather than in the market. And actually, if you think about that's pretty much happened to all business functions, from research and design to sales and finance. So it's all quite logical. So Barbara, if you look at the development, where does tax come into all of this?
I guess I would start from the basics, that tax liability ultimately is tied to a particular legal entity in a specific country, which means the challenge is how do you correctly attribute a part of the profits from the international supply chain to that specific country? How do you carve up the global profit? So perhaps one country is hosting a warehouse, another has got is the manufacturing location. There's a third country that houses the international supply chain team, the group that makes the fundamental supply chain optimization decisions. The activities conducted in all three of those countries are contributors to the ultimate customer transaction. The separate entities in each country may get a different part of the overall profit pie. They're taxed on that amount in their local country at the local prevailing tax rate. So the OECD for many years has provided international guidelines to help global businesses attribute the right amount of profits to the different operating units or entities within their groups. A basic fundamental shift is now happening that is refining and re-emphasizing the elements of that allocation with a particular focus on where the key decision makers are. And I think the OECD focuses on decision makers because they take the view that in some cases the allocation of capital, the bearing of risk, may be too divorced from the people with the authority to make the business decisions in respect to that capital and those risks. So the OECD has pointed to situations where profit may be allocated to entities, but those entities lack the necessary decision-making functionality. The OECD seems to be concerned about the possibility of a company that has significant capital, has significant contractual business risks, but doesn't have the people that actually make the decisions with respect to the use of either that capital or how to handle those risks. So the OECD suggests that the results of that situation can skew the company's tax profile. At the same time, there are countries very involved in the OECD process that have been vocal about ensuring that the OECD doesn't go too far in disregarding capital and risk bearing, because those are very important elements in the value chain. so with some balancing of these different perspectives, the OECD transfer pricing guidelines in this area are being amended as part of the BEPS project. And at the same time, and a really important element is that the requirements for information reporting to tax authorities have been increased quite dramatically, meaning that it will be apparent to the tax authorities situations where there are entities that have profits and that at the same time lack significant people functions.
Yeah, no, that's very clear, Barbara, and I think that's really kind of a great start to understand the whole kind of BEPS drive a little bit better. So what can business leaders expect from your perspective?
Well, I think an important point, as I noted, is that people functions are being emphasized more. Contractual risk is being emphasized somewhat less. Business leaders really need to verify whether the allocation of profits to the various functions is in line with the new guidelines. Otherwise, there's a risk of a tax challenge from one of the countries involved in the value chain, one or more. A country that believes that more profits should be allocated to the contribution from that location, and there may well be competing challenges where more than one country believes sort of the same portion of the profits should be allocated to that country. The likely outcome of the global focus on BEPS is that segments of the operating model may require making some adjustment to the supply chain in order to align with the new transfer pricing guidelines. The adjustments to the operating model could include changes in the transactional model as well, because of indirect tax implications. So I think it's the case that many enterprises will need to find a new balance in how decision-making and accountability are represented across the managerial roles. And that may mean more managerial roles in more locations than has been the case in recent years.
Yeah, no, that's clear. Jürgen, let's switch to you for a second and take it away from a more tax view into that business view that Barbara was just mentioning. If you look at this from a business management perspective, what are your thoughts?
Well, Joost, at a first glance, that sounds all very logical to me. Businesses can basically benefit from the level of clarity and even stronger alignment between different elements of an operating model. Clarity usually is a good thing. So that integration between tax and business operating model makes sense to me. The realignment of tax and the operating model, business operating model, in order to reflect those changes may obviously require some time and attention and work from the business leaders, and can have material impact if not managed proactively. Competition may do it proactively, so better be at the front end of it. I've seen recent cases where the business worked for months on supply chain concepts. One specific case was on a new distribution center strategy, and when presenting it after 6 months of design work to the company management, which included the tax director on the table, it turned out to create unwanted tax outcomes and financial impacts, questioning basically the whole business case and turning it south. So that shows that urgent need for alignment and redesign of the concept was mandatory and should have actually been done much earlier to avoid effort and a time impact. So attention, work, yes. On the other hand, the upside is that this call for clarity and alignment between the two sides of an operating model, business operating model versus tax operating model, and the transparency in that design is a change, and to define a more competitive operating model. Again, other companies, your competitors, will go into this, so there can be good outcomes to become more competitive.
Yeah. It's interesting, Barbara, and you're both, the word alignment of business and tax is coming back all the time, and I think that's clearly a theme throughout here. Julian, switching to the Asian perspective, what's your take on all of this?
Well, I think we've got a very consistent view, Joost. Asia is obviously home to many aspects of the global supply chain, value chain, and sourcing and manufacturing are two fundamental activities that immediately come to my mind. We've seen a variety of operating models being implemented over here in Asia to support these functions. Singapore and Hong Kong procurement centres are obvious examples, and many of these are significant operations. But I've also seen examples where the actual managerial substance is limited, and the reliance appears to be more on in-factory sourcing, combined with a foreign HQ giving direction. And in these cases, the actual procurement centre's role is somewhat caught in the middle. And based on what Barbara just said, I can see that these types of situations will require some form of alignment between business and tax in the future.
Yeah. So that's consistent point coming back. That's great. So basically, if we look at all of this and listen to what the panel has just said, there's two things really to focus on. First, inconsistencies in existing operating models. In other words, where the BEPS guidelines are actually giving, let's say, unwanted outcomes or unintended outcomes of an operating model that was implemented previously, and that simply means there is some form of alignment adjustment to be made. The second point is, I think that's very relevant for people online as well, if you're planning to drive real international business change. So if you're changing, focusing on enhancing the company's financial performance by changing how or where or with process decisions are made, you'll undoubtedly be impacted by BEPS. So now these two situations, and they'll come back throughout further discussions, are important. They carry, let's say, a corporate risk as a result. On the other side, and we've heard that too, there's also an upside, which is all about an opportunity to actually define a better integrated operating model, and that should benefit the business as a whole. So now with that, the BEPS scene has been set. I think let's take it a little bit more practical now, and let's talk through a number of business scenarios to explore the BEPS impact a little bit better. Julian, we have 6 areas. Do you want to introduce those, please?
Yeah, so first, Joost, we're going to talk through the implications on sales and channel management. Then we're going to move through procurement to manufacturing, and then the deployment of inventory along the extended supply chain. And finally, we look at innovation, R&D, and product development. For many companies, this is a major expense area and also a key source of future profit. The nature of intellectual property, or as we'll hear later now defined as all intangibles, and the deployment of this along a value chain is now an important and fundamental BEPS topic. Yeah,
no, exactly. And I think there's 2 other areas on that slide here. The first one is cross-border activity. And that's really, and we'll pick that up in a bit more detail later, the fact that a lot of executives in companies are truly working cross-border and international these days. And again, that clashes with that legal entity focus that we discussed earlier. So that's an important topic we need to touch on. And the outer ring there, transparency and reporting, again, Barbara alluded to this. This is a cornerstone of BEPS, reporting more detail and the transparency of how your operating model is structured. So now, given that's important, let's kick off with that. Barbara, just maybe from your perspective first, since this kind of transparency and the exchange of information is such an important part of BEPS, can you just briefly share with us what is the type of information that companies are required to share?
Sure. So in connection with the BEPS project, there really are 2 separate instances of increased information gathering. First is the so-called country-by-country report, which requires companies to submit to their parent company's tax authority information that provides an overview of the profit, revenue, taxes, assets, people on a country basis. The parent company's country's tax authority then is required to provide that information to other tax authorities, provided certain agreements and conditions are in place. The second type of increased reporting is the OECD's recommendations of a new format for tax information gathering in the transfer pricing area. It's referred to as the transfer pricing master file. With this master file, businesses need to provide quite detailed information about their end-to-end supply chain, corporate legal structure, their intangibles, their business's intangible strategy, their group financing activities, their tax policies, and information about certain agreements with the tax authorities.
Yeah, thank you, Barbara. That's clear. That's an enormous amount of information that's shared. Now, if I look at that, two immediate questions, and Jürgen, I want to turn to you for a second. Are international business actually able to produce some of this information, first of all, because there's a lot being asked? And secondly, are there any risks, competitive risks associated with providing all this information?
Okay, let's first briefly talk about the type of information that companies will need put together to get to the mentioned country-by-country report and the master file on a periodic basis before I then touch on the ability to produce that information. So generally speaking, the required information is really not rocket science. But remember, the OECD and the tax authorities, they take a rather legalistic and country-focused view, while in today's world, companies usually look at their businesses really from a business unit perspective, such as product segments or market segments or any other BU logic, so not really from a country-by-country perspective. The country-by-country reporting is really mostly focusing on the quantitative data, and we see on the screen a template. You will recognize some of the data that at a push of a button will show certain ratios, such as profit per employee versus the effective tax rate in a country. The basic information that companies will need to report from a country perspective, for example, are revenues with related, unrelated parties, profit, taxes, number of employees, asset values, but also some of the main business activities such as R&D, sales, procurement, manufacturing, and finance that are basically performed in that specific local country. Actually, this information should be present within any multinational's financial reporting and HR system. However, it's also information that is typically not sitting nicely in one system next to each other and not readily structured in exactly the way you would need to report on it, including reconciliation between countries. In the worst case, some of the information is maybe not recorded in the way that would allow you identifying them as what they are. Example could be a clear distinction between related party and unrelated party revenues. It sounds trivial, but I've seen systems where that simply doesn't happen, or companies. Clearly, the maturity of the IT and reporting environment of a company will make the difference here, but I'm expecting to see actually all flavors based on my experience. Certainly, there is a job to be done mainly for IT, finance, controlling, and HR based on the data that we have seen to deliver the required information, and ideally without major efforts on a regular basis. The master file, so with respect to the master file, more qualitative business context needs to be provided besides the quantitative data of financial statements and transfer pricing and the likes. These informations, such as important value or profit drivers, what makes you win in the market, basically supply chain descriptions of the most significant products and services by turnover. We're talking here about the 5 largest products and services by turnover and the ones that make basically 5% of your turnover. And their main geographies. In addition, so-called functional analysis needs to be provided, and that's really about responsibilities of central organizations or organizations in general, and their contribution to the value creation of local entities. That needs to be described. This goes clearly in the area of organizational responsibilities, processes, and decision-taking, and really needs input and good documentation from the respective business functions. And it should really reflect reality and not just wishful thinking there. So companies should not only think about where to find the data, but also how they can be organized and be maintained on a regular basis in a hopefully low effort way, like any other reporting. Talking here really about establishing a good process, clear responsibilities, but last but not least, also hopefully a good degree of automation. Joost, you mentioned one additional question: how safe is the information that will be disclosed to tax authorities? Well, in today's world, with incidences on data privacy and cybercrime on a daily basis, well, I cannot really answer that. One has to assume that obviously tax authorities will protect and treat that data confidential. I'll leave it with that. I cannot say more than that. Yeah,
I think it's fair enough. I think back to that first point you made, it's hopefully clear to everybody listening in now that there's actually a significant amount of information being shared, and you can imagine that gives a very good insight in the business. One point I would have is it makes you wonder how the authorities will actually have the capacity to analyze all of this, because it's significant. And now, Jürgen, other than the workload and the potential systems implications that you outlined, is there an upside for businesses on this, or is it all kind of reporting out and no value back?
Yeah, interesting question. Good question. As mentioned, companies are usually steering and looking at their businesses more from a business unit perspective, and sometimes the view of what a local country contributes to it is less in focus. Obviously, in an international value chain, country operations do not operate in isolation and depend very much on the input and output of other regional or global operations. Nevertheless, with the combination of information around revenues, profit, capital, taxes, employees on a country-by-country level, one could think about various insightful reports that can help to determine performance issues by comparing various internal ratios and productivity benchmarks. So, yeah, the data can be used, certainly. As a matter of fact, and it's on the screen now, you see a simple rework of the information required by the tax authorities in some comparative analysis. So it's two things stand out here. Firstly, authorities can easily perform this analysis too, as we just show here and did for you. And it's rather straightforward to put your finger on the areas of potential assumed inconsistencies that may need further explanation. Second thing worth mentioning is that the reports will also show markups and profit levels of all individual countries. Well, you can imagine that this will attract immediate attention from authorities who will want to understand why one country is treated different from another, potentially, but it's also possible maybe for your internal operations managers to get interested in that and want to understand the differences too. I'll leave it with that, but I think it's clear that transparency levels are unprecedented and will drive external and internal questions, like we just raised some of them. So business leaders are advised to run various mock analysis and be prepared.
Yeah, no, that's great, and hopefully this will also indeed bring some of that internal value and questions, which is also of benefit. So thank you, Jürgen. That's very useful. Now let's move on to the next topic, and that's of virtual and cross-border management teams and the impact BEPS has on that. Julian, we touched on the supply chain example earlier on. Can you share a little bit of what you see happening in general before BEPS on how cross-border management teams are actually operating, maybe with an example or so?
Yeah, sure. A classic example is the S&OP, or Sales and Operation Planning process that many international product companies run. This process has input and contributions from a whole raft of people from different geographies and functions. Sales teams, for example, provide market and product sales forecasts. Regional commercial teams will give their views. The sourcing department will highlight material sources. The manufacturing guys will talk about anticipated capacity issues, And the supply chain group, well, they'll update the on-hand inventory positions along the supply chain. And all this goes into a melting pot to produce various plans that are discussed in a series of phone and video calls throughout the month with all attendees from all of those functions to eventually get to a single one-number agreed plan. And that plan is then signed and sealed at the highest possible authority in the business, sometimes even as high up as the CEO.
Right, and so that's a classic sales and operations management process. That's clear. So lots of people contributing. Taking that into BEPS, where are the implications?
Well, the implications come from a number of angles, Joost. The sales and operations planning process is, especially for consumer product companies, fundamental. It sets up the supply chain for success and makes some of the tough business choices. And as such, the representatives in this process are taking important decisions. From a tax angle, this would be seen as potentially deserving a profit allocation based upon where the decision maker sits. However, the process is often managed in a virtual way. For example, the key process owner may sit in a management centre in country A, but the commercial director, who is an employee of the management centre, actually may dial in from another country. The procurement team may have already moved to Asia so they can be close to the suppliers, and the supply chain organisation may sit somewhere entirely different. Also, the voice of some of the large market-facing organisations is becoming increasingly important in making choices. So there are choices and decisions going into a centrally managed process from all over. So whilst the central nature of this process was historically pretty much accepted as being run in the management centre with profits allocated to it, under a BEPS lens, the profits could need to be split somehow between the participants and their locations. So you can imagine the complexities involved in doing this. Business leaders may now be asked to provide their input in deciding the weight and importance of certain functions. And at the same time, some of the virtual nature of these fundamental decision-making forums may become more grounded from a limited set of locations. Or perhaps business uses this change as an impulse to make the process even more centralised. Many variants are possible, but most certainly processes like this will require review from the business owners.
Yeah, I can see that, and that's getting very, very clear now, Julian. Just out of interest, that commercial director dialing in from country B, any wider implications?
Yeah, well, in this case, the commercial director was actually hired not in country B, but in country A, and she relocated back to country B for personal reasons. She then started to work from an office in company B, which was affiliated to the company. So, because it was more practical for her, and she only visits the central company in country A, so there's an obvious tension there.
Yeah, it's interesting that, and we see that clearly very often, especially with the kind of race for talent, that people have some personal choices that may not always align with the business. Barbara, if you put your tax/BEPS hat on, what do you think of such an example?
Joost, I keep my tax/BEPS hat on all the time.
I know you do.
I think that example could involve consideration of what the tax folks call a permanent establishment, or PE. Despite what the words seem to suggest, a permanent establishment can often be created even if a company doesn't have a physical presence, like an office in a country. So, for example, the company doesn't need to set up any sort of facility or even station a person with a degree of permanency in the foreign country to create a permanent establishment for tax purposes. PE risk is essentially the risk of a company creating a taxable presence in a foreign country. In this case, the business activities of the commercial director may be considered to create some form of taxable presence in country B for the country A central company. If so, country B could claim that some of the profits of the central company that the commercial director manages and controls are in its country B's taxing jurisdiction. While this has long been an issue, possible PEs, I think, in the post-BEPS world are now under the magnifying glass. So as we discuss later, the OECD BEPS recommendations include a proposal that would lower and really make vaguer the threshold for finding tax nexus from a corporate tax perspective.
Okay, that's clear. So this is really, and I think that's important, this issue has always been there, but what you're saying, it's going to be much more looked at now. Now, one thing is I may have an issue, but what's the real impact of such a thing?
So in real terms, the impact would be a potential tax liability for the central company in country B, as well as an increase in compliance costs, because now the central company, headquartered in country A, may have to register as a branch in country B, may have to start keeping books and accounts to ensure that profits are properly attributed to country B as a result of the commercial director carrying out her business activities on behalf of the central company in country B. In addition, there may be indirect tax implications as well, which could possibly mean that there's a need to consider changes in the business's transactional model, how it does customer invoicing, and none of this changes the central company's tax obligations with respect to country A.
Yeah, it's very interesting this, because it shows that these location choices that are sometimes made on a rather case by case or an individual basis actually do carry quite some implications for a business, or can carry some implications. So I think it's very important that people are aware of that. So thank you, Barbara, for that. Now, Julian, any final comments on what BEPS means for this virtual and the kind of exceptional working arrangements for senior management?
Well, yes, I think that virtual working, top management teams traveling around their areas, rotating locations for various teams and board meetings and the likes, they're only going to increase in the future. So here, BEPS increases the complexities of aligning business activities with tax outcomes. Yeah.
There's that famous alignment word again. I think that's hopefully getting a bit of a theme for everybody now. That's where the real challenges will be. And they're the challenges that you can overcome. It's just, it needs to happen, right? Now, moving from that over to sales, the front end of the business. And again, on sales and channel management, the OECD has defined a number of quite specific guidelines. Jürgen, can you give a little bit of context, please, on that?
Sure, Joost. In many businesses, the interface with the market and impacting customers is often the sacred cow, and any changes to it requires careful consideration and implementation. I think that's very common to many businesses. BEPS, in fact, could have a direct impact on the way sales personnel interacts with customers, with whom customer contracts and transacts. So let me get really more specific immediately and list here the businesses that should look into this to see if there are BEPS impacts for them. You see it also on the slide on the above the dotted line, so to say. So firstly, companies that run so-called sales agent or sales support models. These are companies that have sales personnel in countries where no real selling, billing legal entity is located, and where the customer ultimately contracts and gets billed from a foreign legal entity. Secondly, and that's the second piece above the line, companies who run commissionaire models in countries. People working in those companies with such sales structures would know it, how that works, but for those on the webcast that are not totally familiar with it, let's imagine you're at an auction. You look like you're buying from and paying the auctioneer as you receive an invoice from it. The fact of the matter is that the item that you're buying is not owned by the auction house, but an undisclosed party in the background, so to say, who pays the auction house a commission for facilitating that sales for him. The ownership of the item basically would change directly from the undisclosed party to you as a buyer. So that's the commissionaire concept. Now, without going into details how exactly, but both types of sales models, BEPS will impact business by increasing the risk of creating a taxable nexus, a so-called PE, again, through the sales activities that the local salespeople perform for the foreign entity. As we've learned before, a permanent establishment does not only create tax burdens potentially, but also can lead to compliance requirements. These compliance requirements can relate to both direct and indirect taxes, whilst the rules for permanent establishment are not always consistent between these two areas, direct and indirect taxes. There may be a permanent establishment for indirect tax purposes as well. And this can really then imply that transactions need to run through these PEs. And as a result, sales and purchase transactions may actually need to be accounted for in a different way. And again, there are implications that this would immediately then impact ERP systems, which usually support transaction flows and the indirect tax treatments behind it, and also accounting and reporting.
Yeah. It's very clear, Jürgen, and quite significant again. So what can companies do to deal with these issues?
Yeah, one of the options is, of course, accepting and dealing with the permanent establishment and the consequences of it. But another option or part of the response might be changes to the sales model and structure itself by, for example, changing it to local selling entity, which you see on the part below the dotted line on the slide. So this would effectively change the party a customer contracts with, including all the related consequences of internal processes and IT system and the likes. Instead of the foreign selling entity, the customer would now contract with the local country sales entity and billing entity. As a consequence, customers may receive invoices in local VAT with local VAT, where this was not the case earlier when it was cross-border sales and potentially 0% VAT rated. So this can have possible cash flow and working capital impact both on supplier and the customer. And we've already experienced negotiations due to that on new payment terms. So that's happening.
But Jürgen, it feels a bit like a sledgehammer. You're changing an entire sales model to accommodate these new guidelines. So that seems like some serious implications. Other options, other alternatives to that?
Yeah, sledgehammer, true, but it's happening. So companies change their sales model, but there's obviously also considerations with less structural changes as the previous one, which can involve tightening of the operational involvement of the sales force. Tightening their ability to price, negotiate, conclude contracts could help to manage the risk of a permanent establishment being created, but could also cripple the business if it's not implemented carefully, or if it's simply the tightening is simply operationally not really a good fit.
Yeah, that also sounds like a great excuse to not meet your sales targets. So doesn't that constrain the ability of the sales teams?
Yeah, you would be surprised. So sometimes the tightening of do's and don'ts is exactly what a company would want to do anyway to gain better control over things like product mix and pricing and margin and contract terms. This certainly varies and needs to take industry, market, and product-specific requirements of doing business into account. So there's not one size fits all, and for some businesses, the tightening would really be a total no-go because the business would basically be crippled. But when going that route of tightening, it's utmost important to reflect that then also in your performance measures and KPIs of the impacted roles. We all know that, including us, behavior is majorly influenced by incentives and KPIs. We're all driven by KPIs to a certain degree, and measuring, in this case, for example, the sales agent still on full margin or EBIT level, while the do's and don'ts, such as strict pricing and discount guidelines, effectively restrict the ability to influence such thing, majorly creates an obvious mismatch then and raises concerns about the lived reality. Such a mismatch would basically again raise a PE risk, and we're back to square one. Now, the described and required alignment of performance measures on a legal entity and an individual level to the corresponding sales model is really an attention point for both of the earlier mentioned business situations, in case you go for new business changes or you're planning to do that, or you're in an existing model that is somewhat not aligned and the business operating model is a little bit inconsistent with the tax model.
Yeah. No, clear. Then let's add a little bit of additional complexity now. If you look at the whole digital world and let's say online sales for a second, How does that all fit together?
Yeah, digital is obviously a hype word right now. And it may sound a little bit funny. The do's and don'ts that I mentioned should also be extended into the digital world. Simple examples are the social media network sites. In many cases, the alignment between job description and KPIs is not very well reflected in job profiles. So exaggerating your role in the digital world may actually increase your company's tax risk, because authorities will use all of the information that is available out there. While there should not be anything to hide, you want to ensure consistency also in the digital world. On the indirect tax side, in the digital economy, we've already seen a big change in the EU by implementation of the 2015 place of supply rules. Especially this means moving to a system of taxation where consumption takes place as opposed to where it is supplied from. We've seen companies' existing operating model, pricing models being changed, leading to a significant impact on the entire business there.
Yeah. Okay, interesting. Let's wrap this up and move over to procurement. Before that, any final thoughts on the channel side of things, Jürgen?
Yeah, one more important area worth mentioning is the area of consignment stock, where, for example, you have inventory sitting at a customer premise or a 3PL warehouse, but held by one of your foreign companies, not established in that country. Typical example may be medical company who holds consigned inventory at their customers, in this case being the hospitals. But there are many other industries that apply consigned stock policies. We already know about the indirect tax complexities of making that happen through a central supply chain company or a foreign company of their group. What may happen now with BEPS is that the foreign-owned consigned stock may actually create a taxable presence of that foreign entity in the country where the stock is held, with all the associated compliance, registrations, potential unwanted tax outcomes. Obviously, customers like consignment stock because it's reducing their working capital and inventory risk. You as a company may do it because it's part of service levels towards your customers. So probably you don't want to change that practice, but it's very likely that your tax team will want to talk to you and discuss alternative approaches with you, such as consigned inventory, because consigned inventory might just put an additional cost factor now into your supply chain, and that is bottom line. Being a potential financial impact from a tax perspective. So that was worth mentioning, I guess.
Absolutely. No, it seems relevant, and this will certainly hit certain sectors more than others. Okay, thanks, Jürgen. Now moving to procurement. Vas, can you give us a quick overview of, if you look at the total kind of procurement and sourcing area, the kind of structures we've seen over the last few years and how that function has been delivering value to the business in general?
Sure, Joost. Over the last decade, we've seen leading procurement functions define their success through how much business value they deliver, not just cost reduction savings through improved source prices. The reason being that once procurement achieves significant price reduction through sourcing, a set of new levers need to be pulled to untap and deliver further value. So what does procurement business value entail? Under the procurement business value umbrella, we see category management effectively as a science, which includes the following: product rationalization, demand management, state-of-the-art negotiations and sourcing to achieve price reduction through demand consolidation and hedging, targeted value engineering, such as considering alternative packaging to improve total cost, targeted supplier relationship management to improve both performance and quality. And all of the above, of course, are supported by business intelligence in the form of analytics and commodity market trends. The way in which many multinationals have executed this type of procurement value has been through above-market structures, and a mix of operating models depending on industry and maturity levels. So we see operating models range from lead buyer to central hubs to complete centralized buy-sell hubs, or a combination of the two.
There's just a second, a buy-sell hub, what is that exactly?
What I mean by buy-sell hubs is where we see procurement functions not only own category management, but also own inventory and managing the risks around this before they then transact with the business units to sell or supply them with the direct or indirect materials. Setting up procurement functions that operate above market, so globally or regionally, poses challenges not only during design and setup in terms of what activities and roles should be executed above market and what should stay locally, but also post-go live and during execution in terms of consistently operating in the new way.
Okay, that's clear. And I think what you're saying, that different models exist for different industries and different maturity levels. And you also mentioned challenges companies face in terms of global, regional, and local functionality and parts of the organization. Now that seems to be close to that whole substance point you mentioned earlier. Can you expand on that a little bit?
Mm-hmm. So in the changing legislative landscape driven by BEPS, procurement functions operating at a global, regional and local level will need to be able to evidence that strategic decision-making, such as supplier negotiations or other commercial decisions, are carried out by the roles and within the tax jurisdictions they are assigned to. So if, for example, we have a global category leader in a centralized management location who is negotiating in and signing contracts in Latin America, for example, they may be putting their multinational at risk. Furthermore, we see a shift in what is recognized also through BEPS as a benefit, what's recognized as a benefit by tax jurisdictions. We have, for example, countries where pure demand consolidation is no longer considered a benefit delivered for global or regional centers. This requires therefore global and regional procurement centers to focus and report on business benefits they deliver beyond volume consolidation. Luckily, there are plenty of such benefits, and this means that global and regional procurement centers can continue to earn an income stream from the value they provide.
Yeah, no, that's clear. Barbara, to bring you back in here, what do you see are the likely tax business alignment issues that may exist in these situations?
Well, I think the implications of the BEPS recommendations here are that in the future, the activities of procurement offices could potentially create PEs for the operational entities for which the procurement is happening. The main question will be whether the offices habitually act outside their home country in the following manner. Do they negotiate or play the principal role in getting contracts signed? This means that even if the procurement personnel themselves aren't the ones actually signing the contracts, they can still create a PE if it can be shown that they played the key role in getting the deal done. Or do they act exclusively or almost exclusively on behalf of related group entities when performing these procurement functions? What this really means for business is that if they want to avoid any possibility of having PE issues in a black and white world, the procurement people should no longer travel outside their home country to do business on behalf of operational entities. As we all know, that's virtually impossible. Doesn't make sense for the business, so where does it leave the company? It may be the case of setting a clear policy. So going back to the comments earlier about specifying the do's and don'ts for procurement people, companies will have to think about how they can factor this increased risk of a potential taxable presence into their procurement models as they design those models.
Yeah. No, that's clear. Thank you, Barbara. I think just looking at timing for a second, we're coming up on the hour. Two topics we want to cover still. One is supply chain and inventory deployment, which we'll carry on to now. And then there is a subsequent piece on intangibles, which which is very relevant for BEPS. And that's, so in total we'll run about 20 minutes from here to cover those topics. So Julian, moving to supply chain and inventory. Just a question. You keep telling me that inventory has just become a tax topic. Can you clarify that a little bit for me, please?
Yeah, that's right, Joost. Inventory, where it's located, who owns it, and how it's managed can impact how much tax is paid in a particular country, and also what you need to do to keep your current status in an environment where tax is changing. In other words, business and tax will need to come to an agreement on how to deal with situations in the future.
So why is that, Julian?
Well, let me give you an example. Let's say that a factory is set up as a toll manufacturer. That's country B on the slide. And in this manufacturer, the raw materials, it converts into finished product, and the warehouses that the materials are stored in are owned by the supply chain organisation, and that's in a different country, country A. So both the factory and the warehouse hold a stock owned by another party, and that means that they may now be considered a PE of the foreign supply chain organisation. And this is especially so if that organisation has access to the stock for the purpose of managing the inventory, and that this activity represents the core business of the company. Now, Barbara explained earlier that PEs are important for the business to think about because foreign companies create taxable presences with obligations for them to register as local taxpayers and file tax returns where previously they didn't have to. And there's likely to be an increase in disputes over where the appropriate profit should be allocated to the PE for tax purposes should be. And these disputes could well slow the supply chain down by delaying customs clearance, for example. But on the whole, the point is, all this could increase the company's overall tax bill. This means that the policies and procedures in place regarding warehouse and toll manufacturer access and stock control should be reviewed to see if they need to be modified to ensure that no PE is created.
Okay, clear, but Julian, that's not true for all cases, is it?
No, it's not. It applies only when the inventory is owned by a foreign company, in this case, the foreign supply chain organisation. However, factories set up as contract manufacturers and locally managed manufacturing, where in both cases the inventory is owned by local organisations, well, they're not impacted. And it may not apply in all toll manufacturing cases either. There are a number of questions which you need to ask to find out, and these include, firstly, the locations of the facilities and other activities that the business has in those countries. Secondly, whether materials warehousing is considered an essential and significant part of the business's activities. Thirdly, who operates the warehouses. And finally, what the processes and procedures in place are regarding warehouse access and stock control. The same situation may be true for other inventory that is owned by a foreign supply chain organisation at other locations in the supply chain. This could be finished products being stored in distribution centres in country C and D on the slide prior to shipment to customers. And in this case, it's important to answer the same questions as before, but also others such as, well, who makes the decisions on what product is shipped, who it's shipped to, and when it's shipped. Secondly, how much of the product is shipped within the country the DC is located in, and how much is shipped to customers in other countries. And finally, how much influence does the local sales office have over the distribution centre and the inventory that is stored in it is managed.
Okay, but that's quite a lot of impact there. But PEs at the end of the day are just a tax thing, right?
Yeah, that's right. And Jürgen explained it exactly the same in relation to sales. One of the choices that the companies have is to accept and live with them. At the end of the day, most companies have set up their centralised and above country supply chains to drive down operational costs and working capital tied up in inventory. The advantages of operating like this may still outweigh the tax impact. It could be, though, that by either adjusting some elements of the supply chain operating model or assessing the answers to some of the questions I asked earlier, that PEs don't exist at all. In these cases, it would be important that supply chain managers understand and comply with the changing rules. And those managers will need to be completely transparent in demonstrating that they've got the correct controls and governance in place to prove it. And this could include the governance over access to and visibility of inventory records, access to warehousing locations and stock, clarity over who's accountable and responsible for supply chain planning and inventory deployment, and how people are measured and incentivized. The other thing to remember is the impact of these regulations on your suppliers, as they may too be affected by the rules. Some of these suppliers, as Jürgen said, may be holding materials on consignment close to your production sites and delivering them just in time to your assembly lines. Well, their margins could be impacted, and the organisation they need to put in place to allow them to operate could become more complex, to the point where they may want to share some of the additional pain, complexity and cost with you.
Okay, so there's really quite a large number of impact areas. Thank you, Julian, for explaining that. I think that's very clear. Now let's move on to intellectual property, the last piece of the webcast. Andrew, we're coming to you now, and the OECD has issued a number of statements on intangibles and intellectual property. It's actually a very important part of BEPS. Can you give us the outline of that and the likely impact?
Sure, Joost. We see that companies that view BEPS as being a compliance burden will be at a disadvantage to those who see it as an opportunity. And the opportunity is to rethink the business and what's really driving value. It's fair to say some studies have concluded that since 1975 there's been a shift in value from tangible assets to intangible assets, with tangibles representing 80% in 1975, but actually only now representing 16% by 2015. But intangibles typically contain the company's value drivers and frequently the majority of total value. And BEPS should provide the opportunity to decipher what exactly these sources of value are. And I guess I'd make 2 points on intangibles and IP. My first one is what really is IP, emphasizing the point that BEPS gives an opportunity but also requires business leaders to look at their businesses with a new lens and to learn new skills, because in BEPS language, intangibles are classified as easy to identify. For example, the classic registered rights of patents, trademarks, and domain names. But also harder to identify intangibles, really requiring goodwill to be broken down into a new set of components, such as my favorite, which is negative know-how, in other words, what not to do, which I'll explain later. The second point is how are the definitions of intangibles actually beginning to harmonize and come together. BEPS is only one new initiative that seeks to redefine intangibles, and I want to refer to a new corporate reporting regime which is getting adoption called integrated reporting. And it really has the same aim to similarly explain which of the assets in a company are driving value and what their relative value is.
Okay, that's clear. Back to the OECD requirements, Andrew. What are the specific requirements then on intangibles?
The two that are of real interest to us are detailed information about the first being the company's intangibles and which of these are driving value. And the second is the business intangible strategy by which these are managed. So let's take these in order. It's fair to say that in most companies, and even in sectors such as real estate or let's say investment banking, the drivers of value will be intangible. Even in real estate, some companies outperform others. And the edge there is provided by intangibles such as negative know-how. As I say, what doesn't work. So if you quote Thomas Edison, I've not failed 700 times, I've merely worked out the 700 ways that don't work. Areas like know-how, and you often find that even in real estate, companies get to copyrighted models for measuring key performance. But as the world socially connects, it is arguable, and I would argue, that new value drivers are less the easy to identify and value intangibles, but more the hard to identify. Let's just take examples of corporate purpose, culture, diversity, key relationships, sustainable supply chains, and inclusion, or a user community. Last month we actually started to think through what was the impact of Mark Zuckerberg donating 99% of the value of his Facebook shares to charitable causes. You can feel the impact on Facebook and its purpose, and to our way of thinking, that's an intangible asset. So we are looking at hard to identify resonance factors. The second part is the OECD requirement to disclose a company's intangible strategy, and this really is groundbreaking. Few companies have a clearly articulated strategy to cover even their easy to identify intangibles, never mind those hard to identify. And the impact is that companies will for the first time be required to look at themselves through an all intangible lens, place descriptors on each of their intangible assets. That's why I describe it as groundbreaking. But the benefit, and I do want to emphasize this, the benefit is this gives management a different level of awareness on the specific areas of value. And in some cases, this might actually lead to different investment choices and allocations of capital. For example, a limited value impact of one business area or product against another.
Yeah. No, that's clear, and I can see the importance of that. Barbara, if you look at this specific focus on intangibles, because this is indeed groundbreaking, the OECD is also really focusing on kind of organizational functions and substance that help to create and maintain the value of intangibles and intellectual property, and it's these so-called DEMPI functions. DEMPI standing for develop, enhance, maintain, protect, and exploit. So what's the likely impact of this on companies?
The DEMPI construct is a means through which the OECD proposes to evaluate ownership of intangibles for transfer pricing purposes. The view is that if a legal owner is to be considered to earn all of the returns associated with the intangible, then it must be involved with all of the functions, risks, assets related to the development, enhancement, maintenance, protection, and exploitation of the intangible. If the legal owner doesn't meet the criteria, then other entities controlling and or performing the important DEMPI functions should be compensated and consequently should earn a portion of the return related to the intangible. This doesn't mean that physically performing these roles is necessary, but oversight and control of these functions will determine the entitlement to the intangible related return. In practice, how one determines what an important function is may be difficult. The OECD's final guidance is explicit in the questions to be answered, but the fact-finding will likely find areas of gray. Some of the questions that need to be answered are: what drives the industry? What is the company's business model and how does it address industry drivers? What are the key functions, risks, and assets in the company's model contributing to value creation? Is there more than one responsible party? Who's accountable? Does the intercompany contract align with the responsibilities and accountability? Answering these questions isn't a simple task. As has been mentioned earlier, when talking about reporting and transparency, it requires business input related to organizational responsibilities and processes with related documentation of all of that. So ultimately, you have to know what relative contribution each function makes to your value chain. That makes that kind of analysis and monitoring critical.
Yeah. And let's take that into an example, I think, just to make that a bit more clear to the audience. Jürgen, from a business perspective, can you give us an example of a typical R&D function within a company's value chain, just an end-to-end kind of example?
Yeah, I'll take the example of a global tech business that designs, manufactures, and installs software with embedded software technology. Company invests over $2 billion per year on technology R&D and is subsequently wants to develop into marketable products and services. You see some of the facts I'm stating now on that slide. R&D pool exists of 5 global hubs in US, India, Germany, and China, housing a total of 20,000 people. R&D leadership is spread over 3 locations, Switzerland, India, and the US. And the core R&D leadership team consists basically out of 4 people. It's the VP of R&D, 2 technology group leaders, and a representative of the customers and markets part of the organization. They talk monthly to discuss the progress of key R&D projects, and each quarter they review the annual priorities and make adjustments where required. Also, the CEO attends on these quarterly meetings. And actually, these meetings are often calls or videos, video conferences, again, getting virtual here, because each of the 4 leaders are based in different countries and are often traveling to R&D sites, so hard time to get them together. And the legal owner of the intellectual property is actually a central management company. Okay.
Quite a rich example there, but I'm sure people will recognize components of this in their own organization. So, Jürgen, if we take some of Barbara's points earlier on DEMPI and what's driving the value and what are the key functions. Back to that substance piece. What will be some of the challenges if you look at that picture that we can expect?
So from what I understand in respect of DEMP discussion, there are for me a few challenges. If you look at the setup that I just outlined, are those four wise men that I talked about, VP and R&D technology leaders, truly making the decisions in isolation to direct 2 billion worth of annual investment? Do they really have all the R&D know-how to undertake such important and strategic R&D decisions? Or do they rely on structured and detailed input, but also creative and innovative thinking and recommendations of their teams? Some based in those R&D pools. Second challenge I would put out is would the central management company that owns the legal rights to the IP be entitled to all the income from the IP under the new BEPS thinking? My example suggests that the 4 managers plus the R&D teams are significantly contributing to the creation of the valuable intellectual property and intangibles. The roles of the central management company does not seem to appear so clear to justify the income of all the developed IP without recognizing some of the other contributors that are around the world, not in that central management company. Third challenge I would put out, what about the functions of the R&D teams in these various locations? If they are making significant contribution to the development, enhancement, maintenance of the intangible, will more of value creation need to be recognized for their efforts? And that puts again a challenge on the central management company. Based on these challenges, companies certainly need to revisit how they look at IP ownership from a transfer pricing for transfer pricing purposes. But there's also a really interesting question from business people here. Could BEPS actually influence your current or future R&D center setup or locations? Andrew will provide more details soon, but the quick answer is yes, it could, as tax cost for IP-related financial flows has just become a more important cost element in your business case for setting up new R&D centers and locations.
Yeah, so some real implications there. Huh? Whose IP is it? And also what you're saying, the R&D center choices may be impacted. So certainly BEPS is broader than tax here. So thank you, Jürgen. Now, Andrew, can you talk to us a little bit more around some of the issues and challenges of identifying IP?
Sure. I'm going to do this actually in this example by looking at 2 aspects. First of all, identifying what intangibles are driving value, and then secondly, working out who owns or controls them. So let's go first of all through identification. You can see many intangible assets that can be identified in the relatively easy to identify. We can see these in the core product. So you have core software and hardware, and that's protected by copyright. You're also likely to contain some trade secrets in the algorithms that enable it. You'll also typically find the company collects data, which is confidential information, from which it creates metadata, which is also copyright. Key people and product marketing will create product descriptions, copyrighted, to develop new features and functions in a roadmap, which would also be subject to copyright if it's written down. But we'll also be able to see a range of hard-to-identify intangibles in action. Technology companies, like the one described, are becoming adept at agile development, often agree their roadmap with the user community, which is an intangible, hard-to-identify intangible asset, who contribute to the design. Key engineers, some of the mentioned 20,000 personnel will architect solutions and possess many, many years of what will not work. I come back to negative know-how. It may also work closely with its preferred hardware partner and have relationships by which that partner will thus take the software to market, again, in the area of relationship capital. It will also typically develop and manage a community of external developers that specialize in applications who have databases that are important to the end product. So therefore, you're extending your own creativity and creative ability. The task then is to evaluate the relative contribution of each of these intangibles, both easy and hard to identify, and that's not trivial. It needs solid facts analysis, and as you'll quickly see, a mix of intangibles and also a hard to identify and value intangible in relationship capital. This brings us straight back to the DEMPI functions, and within development, enhancement, management and protection, for example, we would typically see contributions to the core product, not only from within the enterprise, but also from outside the company through the key technology partners and from the user community. It's key to define the document and document where those relationships are owned and who's contributed to them.
It's a very intriguing area. And what are companies doing in response to these type of challenges now?
Yeah, I mean, drawing from the comments above, we are seeing that it requires three things. First of all, ownership of the BEPS issue at executive management team level. The changing rules under BEPS may require multinationals to review their business models to be adapted to ensure compliance in order to avoid material risks of added tax. They'll have to reconsider what's driving value and re-engineer those functions. And this transition to full BEPS compliance, substance, coherence and transparency may take 3 to 5 years to complete. It's also, I guess the second point, a new way of seeing and thinking. BEPS, we believe, will remove the word goodwill from corporate vocabulary. Under BEPS, each intangible asset will need a name and a description. And at the same time, this lens on all assets and risks will, in our view, provide it's a significant opportunity to reshape the corporate strategy and reporting. Also, the creation of a strategy to manage these intangibles and governance structures to manage them, the tie back to DEMPI functions as the business adapts and changes. In our experience, this strategy will be a new document that's not previously existed. And we have seen with integrated reporting that I mentioned earlier that some companies adopting this regime have created new governance structures to be able to think integrated.
Yeah, again, it's a fascinating thing, especially the end of goodwill, as you describe it. Now, does that mean business leaders need to also take tax into account when deciding on investments in R&D centers? Jürgen already alluded to this. What's your view there?
Yeah, absolutely. I mean, the whole DEMPI drive from the OECD means the total cost of an R&D operation must be evaluated, including the potential corporate tax cost of that location. The more independent and entrepreneurial the R&D center is, the more the tax cost will play a part in the location choice. I mean, to me, in this context, it's also important to distinguish between outsourced versus an own or related operation. Basically, if you're able to contract out R&D operations, the potential tax cost that we've spoken about should, in principle, no longer be an issue. However, the outsourcing contract itself may become the intangible, and the value of ownership of that, of course, has to be evaluated.
And why is that, Andrew?
Well, first of all, the taxes for profit allocation apply to related companies and not to unrelated entities. That significantly reduces uncertainty and risk. Question is, do you need to do that for all R&D, or would a couple of instances provide sufficient proof to convince tax authorities in related party jurisdictions? It's really a case-by-case question, but in any case, the true location of investment decision, oversight, direction and control will be the key. This concept can actually be applied to all business functions, outsourced distribution, outsourced manufacturing, etc. But think about who owns the IP in that relationship. It's rarely as simple as an outright assignment to the multinational.
Yeah, it's fascinating. So basically, in the BEPS world, business leaders may expect a call from their tax departments asking them if outsourcing of certain operations is a potential solution or an option, right?
I personally believe that really could happen and should happen as a result of BEPS. But as we keep saying, this needs a contribution from all business functions, not only tax, and driven by what in fact is actually driving value. Also, we're predicting an emerging best practice organization where intangibles managed from the executive management team and where early inputs required in the decision-making process from an essential range of functions: tax, IP, R&D, strategy, investor relations, M&A, legal, financial reporting, etc. It is really, to our mind, going to re-engineer how organizations take material decisions.
Yeah. Okay, thank you. And let's wrap up the intangibles discussion there. I think it's a fascinating topic that we should all be far more aware of. Now with that, I also want to thank all the panelists today for the insights and the experience and the examples. I think it's clear to say that BEPS is truly broader than tax. You've seen that various functions around the value chain will be impacted. Different examples, and some things will kind of hit harder in certain sectors than others. What I want to do in closing is leave you with a short checklist, and that can serve as a simple kind of first tool where you may check if you face some of these BEPS implications. And if the answers to some of these questions is yes, then I encourage you to connect with some of your tax colleagues or us for that matter. So some of these questions are, have you deployed overseas procurement teams? Are you managing inventory that's distributed, maybe consigned stock, your R&D basis, your decision making around R&D, your governance processes? So there's a number of things you can test yourself against to see if you're going to be faced with some of these BEPS implications in either your current operating model or any future changes that you're planning. So I would like to thank you all for participating in today's webcast. A few last comments. Don't forget to tune into the other webcast on the same series. We really feel that this is valuable for business leaders to see the broader aspects of BEPS. Now, a number of specific questions have been addressed as you raise these questions today. We will come back to you to try to close various questions you have raised, and if that doesn't happen straight away now, then we'll come back individually to you. Obviously, feel free to contact with any of us to discuss your specific questions in a little bit more detail. As you've seen, there's a lot to this. So now, if you've been with us for the full 90 minutes and you responded to the polling questions and completed feedback, then you can download your educational certificate clicking on the purple CPE icon at the bottom of the interface. And lastly, the red feedback item, if you can click on that and give us some feedback, that would be fantastic, so we can take that on board. So from the Thought Center, I'm Joost Vreeswijk. We've been bringing you insights into the impact of BEPS on the operating model and the deployment of intellectual property. Thank you and goodbye.